Futures trading is risky and can result in substantial financial loss. Never put a futures position on without a stop-loss order in place.
Good morning, good afternoon, good evening, traders from all around the world. Welcome to Short-Term Trading Live with Oscar. Oh man, we've been going good with that S&P like gangbusters. We've been all over it. If you guys are following me, and you must be because I'm getting the mail like crazy from... Thank goodness this week, compliments so far from the trading. I hope you guys are sticking with it. I hope you're keeping your sell stops in place. Keep your sell stops in place. And let's just stay with it. I say we're going to go again for the upside. Let's keep it running. With that in mind, I'm going for S&P tomorrow. Emini says higher in the spoos. ESH7 electronic. I'm going to buy between 14.56 and 14.54 on a little bit of a pullback. Last trade 14.58 currently in the overnight. I'm going to place my sell stop below 14.49, keeping below that 14.49 area where you put your stop. We're going to look to take profit between 14.73 and 14.75. 73 and 75. Right now we're trading in the 50s. Let's see if we can get that. That should take place by Friday or be out by Friday's close. Strictly day traders, be out by tomorrow's close Thursday. But if you got a notion that I'm going to be right, and your analysis says that we're going higher, and we're in a winning position by the close on Thursday, stick with it and look for Friday as well. I have a rule about that. If you are in a losing position, never hold it over. Never ever hold overnight because it's a loser. If it's winning, you can make a decision. It's always a good decision. Okay, so keep that in mind. Again, quick recap. Buy 14.56 to 54 in the March Emini. Place your sell stop below 14.49. We're looking for the 70s, 14.73 to 75 by Friday's close. We also have the NASDAQ. Emini, once again, going higher. NASDAQ, ENH7 electronic symbol. I'm a buyer on a pullback, 18.15 to 18.13. We're trading 18.22-ish at the moment. Buy them 18.15 to 18.13. Look to put sell stops below 18.01. Little bit of a risk there, but you may get some volatility in that NASDAQ. It's always, whips around a little bit more than the S&P does. Profit objective, 18.43 to 18.45. Also be out by Friday's close. It's a 2-day holdover. If you're strictly a day trader, be out tomorrow. But if you think it's good and it's winning, hold it for Friday's close, or at least into Friday until we get our objective, 18.43 to 18.45. So, Emini bullish S&P, Emini bullish NASDAQ. I think we're going to go up one more day, but remember, keep your stops in. All right, I want to have a little discussion with you. The discussion's going to be a couple of quick topics. The laws of moving averages and the fact that a market, especially a market as largely traded and as popular as the S&P, does not put a market top in with such little fanfare. We had those little teeny highs up there in the 50s, 54, 58. We talked about it on Monday. I gave you guys a note on my recommendations talking about why the market should not just go down because it does not blow off. I'm going to do a quick flashback now. We're going to look at the 13th, 2/13/07, a quick clip from my video of 2/13, just to show you what I was talking about, and then I'll get back to my explanation. Take a look at the clip, and I'll come right back to you. Now, we caught the S&P Thursday, Friday, Monday. Tuesday, you'd expect a little more downside. Not for me. I don't think so. We have the law of moving averages. Look at yesterday's video. I talked about moving averages. I'll mention it again in today's video. 48-day exponential on the S&P. Throw it over the S&P. Tell me if you want to get short this thing anymore. Okay, so with that in mind, here you go. Can you get that in? Get the larger part in focus first, and then I'll read what I have on the words. Okay, you got that?
Got it.
Okay, the laws of moving averages. The first thing we're going to talk about. The next thing I want to talk about, I left a note, S&P Weekly Outlook. This market is currently in the throes of a healthy, likely short-lived corrective phase. From a new contract high set at 1457.70 on February 7th, 2007, we're expecting a corrective low to come in this week around the 1427, 1423 support zone. offering the bulls an opportunity to add to their positions, to their long positions. Now again, this note was posted from Monday forward on my recommendations, so go back and look at the emailed recommendations and you'll see I did mention this to you guys on Monday, Tuesday, and Wednesday. Bullish posture. This market, in my opinion, maintains its bullish posture unless we get two settlements below the level of 1392. Buy dips this week. Keep your short-term minded stops below 1412. Then I talked about, this is the important part of me reading this to you. A market as wealthy and popularly traded as the S&P 500 does not put in its blow-off top with such little fanfare. It does not put in a market top with such little fanfare. A market this big blows out before it puts in its top. That's what I wanted to give you a quick discussion about. You saw that note. You saw it. Take a look at the Rex. You saw what I had to say on the 13th video. I said, that's it. We're not going down anymore because the law of moving averages tells me when we get there, you have to find support. That's one of the laws of moving averages. A moving average that works as well as the 48-day exponential has been working in the S&Ps is going to find support when it gets tested. With that, that was one of my reasons why I set up. And then, again, as I said, a market does not just put in a high as wide as big as the S&P. It's a worldwide market. The mini contract alone trades over 1 million contracts a day. A market that trades 1 million contracts a day does not put in a high, turn around, and then just start heading down. It has a blow-off. It has a move that sort of reminds you of, whoa, whoa, whoa. It just blows off. And then one day turns around for a massive down move, outside day down, but it's generally a big blow off at the top. You cannot be fooled and think the top is in the S&P. I wasn't fooled, but I'm not an armchair quarterback. I'm not telling that to you now because we recovered. I told it to you right when we were in the throes of running down. We were heading down, and I said, whoa, hold your horses. We're going back up. So that's a quick lesson for you. A market will not put in its top. And let me tell you, on my forum and lots of emails, I've had many guys write in the same thing. And you know what? Your analysis is absolutely fantastic. But something as simple as you haven't seen a blow-off should let you know that you still got to be a buyer of dips in this market. And just one of the very many. Okay, the top has arrived with the 119.07 low breakdown in the ENH, which is the NASDAQ, which, as we all know, tends to lead the S&P. Just need to see a confirmation in the ESH, which is the S&P, with a breakdown of last week's low below 1437. I then believe and we will be trading as an intermediate term top is in place and will be confirmed by that price breakdown. Well, I didn't think so. I thought under 37 is going to give us a great buy in the 20s, and that's the way it worked. Hey, I didn't mention your analysis to say anything's wrong with it. Your analysis is absolutely right, and that picture will come to fruition, but not yet, not yet. You need to see a blow-off first. That's my quick lesson about blow-offs. Remember, moving averages, when they're working, always find support or resistance. You can't just curb fit a moving average and say, oh, it looks like it's working and it gets violated a lot and trade off that. You got to find one like I pointed out to you that absolutely worked on every time it was touched. If it went through violently and then stayed above. If it went underneath violently and then couldn't get above again. That's what you got to look for, the law of averages. And don't forget, blow-offs always have to take place before you can say a market is, the top of a market is in, especially something as widely traded as our S&P market. With that in mind, hello, Sue. Thank you from the UK. Sue from the UK. Nice letter, Sue. Thank you so much. Keep studying. Subscribe to me when you're at my YouTube website, youtube.com/futures analysts. When you're there, you can hit subscribe to my videos. Boom. You'll get them the second we put them out. You need to get on my flash updates email list. If you're following my trades and you're with me, I wiggle in and out of the markets constantly. The only way to let you know when I'm about to head out or make a change on a stop is if I flash update you and shoot you out an advisory. I can't do that without your email. Again, I don't sell any. These emails go nowhere. This is for me. back to you. I'm helping you bridge the gap between the days of old of calling the floor and the days of today that we've evolved in where you just keep punching orders in. I'm here for you for that, but I can't really help you with that as well unless you contact me with your email address. So email me, futuresanalyst@gmail.com. Give me your return email address, and I'll start sending you my flash updates. You can call me at 718-351-2266. If you don't want to do the flash updates by email, we can figure out another way. Good luck, traders. Let's knock them dead. Happy Thursday!
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I am a 24-year seasoned trader on and off the floors. This is how I've made my living for many, many years. Good luck, trade.